Our next pick comes from Mark Moreland. Mark co-founded Teaminvest in 2007 with the aim of building a community of people who would consider investments from the perspective of an owner rather than an analyst. They workshop each prospective stock, analysing the company's business model and how it makes money. Well, Mark's selection for Cyber Monday is focused on AI, which he sees as the biggest and most compelling investment opportunity right now.
Basically, my belief is that what we're going through now in AI and the associated computer revolution that's been going on anyway, but it's been leveraged up by AI, is going to be the biggest investment opportunity that we have as investors over the next 5 years. So the challenge, of course, is how do you invest in it and do that successfully? And the company I'm going to share with you today, I believe, is perfectly positioned to generate a triple-digit or 30% plus compound returns over the next 5 years. So what I'm going to do is this company, I'm going to explain this company, but I'm also going to talk about the industry a bit as well so you can understand where it fits. But before we get going, I just want to have a quick make a point about what we learned from the gold rush. If you go back to the 1800s, we had massive gold rushes in Australia and the US. So tens of thousands of miners were lured in for the gold rush, and very few of them struck it rich, and the majority of them left broke. And I would argue this is a very similar analogy to what's going to happen in the IT boom. There'll be a few people who do really, really well, and lots that'll lose their shirts. But what did we learn from the gold rush? Well, we learned that the people who really made the money were the picks and shovel suppliers. They were providing the tools to the miners, and the miners had to buy them. So regardless of whether they struck gold or not, the companies that supplied these goods all made a fortune. So there were fortunes literally made more from the suppliers of the picks and shovels than there were from the actual prospectors. And that works perfectly into our AI analogy as well. So what we want to do is look for the companies that are the proverbial picks and shovel suppliers to the industry, and the ones who are going to go clip the ticket on the way through and make their money. And one example, of course, is NVIDIA. They do that as well because they don't make their own chips, and there's others as well. So back to the present. The company we're discussing is a key supplier of these picks and shovels, except now in a high-tech sense. So they're not physical picks and shovels, they're proverbial picks and shovels. But to really understand the opportunity, you need to understand the industry a little bit. So we'll just cover how it works. If you look at companies like Apple and NVIDIA, they don't manufacture their own chips. What they do is they design them and then contract them out to manufacturers, which are called fabs, or fabrication, because chips are actually fabricated rather than built. I suppose they're built that way. And the leading fab in the world is Taiwan Semiconductors, TSMC, which of course you can invest in, and it's a very good business. Has some political risk being in Taiwan near China, but the bottom line is they're a fabricator. Intel's a fabricator, but also designs its own chips, and there's Samsung and there's others as well. So ASML sells their machines to the fabs, and the TSMC is their biggest customer. So there's a global race on to increase computing power, reduce the cost per unit of compute, and reduce energy use. Now, the energy use is obviously a big one. So there's pressure now with these new data centers that have enormous power consumption, and it's increasing. And obviously with all the challenges we have for the green future and the supply of energy, it's a critical factor of being able to reduce the amount of energy consumed for compute that's processed. So budgets for the major players alone are over $250 billion. That's $250 billion next year is being invested into data centers and buying chips. So what you've got to remember is the companies. So if you look at TSMC, they are selling to NVIDIA and to Apple. In fact, Apple and NVIDIA get nearly all their chips from Taiwan Semiconductors. There's a big problem, though. The only way to achieve this dramatic improvement in performance in compute is to reduce or increase the complexity of the chip. In other words, the circuits will get smaller and smaller, and effectively they're putting more chips on, more transistors effectively on every chip. So if you look at it at the moment, the key technology to do this is EUV, which is called extreme ultraviolet lithography, which is a bit of a mouthful, I know. But what it does is it has a beam, which is an ultraviolet beam that is at an atomic level that actually etches the chips. And there's only one company in the world that can do it, and that's ASML. It's a Dutch company, also dual listed on the US as well, which makes it easier for us to invest in it. So if you look at it at the moment, we're going to just run a video, which is a 1-minute intro into ASML.
There's a revolutionary machine that the whole world has come to rely on.
You could see an EUV machine right behind me.
The size of a city bus, but working with atomic level precision, these EUV lithography machines are the most expensive step in making every advanced microchip that powers the modern digital age. Data centers, cars, and every single iPhone.
We are the only provider on the planet of this critical technology.
These machines are the only way to print minuscule designs on these chips. They cost up to $200 million, and they're only made by a single company, Advanced Semiconductor Materials Lithography, or ASML.
Today, ASML has a monopoly on the fabrication of EUV lithography machines, the most advanced type of lithography equipment that's needed to make every single advanced processor chip that we use today. And this company is one of the most extraordinary organizations in the world. The machines that they produce, each one of them is among the most complicated devices ever made.
Just to clarify, ASML, a bit of a misconception, I guess, that it actually makes chips, but it actually manufactures the lithography machines that are essential to chip manufacturing. And it has a near monopoly, doesn't it?
That's right, exactly right. So ASML is the global market leader in providing these machines to the fabricators, and then the fabricators make the chips on contract to Apple and NVIDIA and anyone else who needs chips. So it's a very specialized area. Intel does the whole thing, designs their own chips and also does the fabrication, but they've been in all sorts of trouble over the last 10 years and have really underperformed the market. So Taiwan Semiconductor, who bought their machines from ASML early in the process, so they were has achieved market leading status doing that now. So they really have no choice. And if you look at these machines, they cost now over $200 million each. And one of the new ones that Intel has ordered is rumored to be close to $500 million, $500 million for one machine. So it's a very capital intensive business being a fab, and that also makes it very challenging for investors as well. But there's no choice. They have to keep up to compete or they'll fall behind and lose market share. So if they don't buy ASML machines, they're basically signing their future long-term death, I would argue. So the current highest performing chips are printed on 3 nanometer silicon, and these are used in Apple iPhones. And each chip has over 10 billion transistors, and the circuits are 10,000 times thinner than a human hair, just to put it into scope. Andrew, we're talking about atomic level small is what these are. So ASML computer processors, their machines, they can't be copied because the technology is arguably the most complicated technology in the world in any company. The machines have over 300,000 parts and they're supplied by 7,000 global suppliers. So they actually manufacture the machines in, I think, 7 parts in different countries, and they bring it all together to Holland to put them all together to test them and then ship them out to their clients. And they're making about 340 of these machines a year at the moment. But if you look at what's happening, as I said, with the AI expansion and the rush to increase compute, the only way is to miniaturize the chips further. So ASML, their product can't be copied. We believe they have a 10-year lead on competitors who are all using older tech. And the reason they can't copy it is because the it's so complex. It's more than rocket science. The beams they generate with their EUV technology are not of the Earth. They're discovered in space. And you want to watch the documentary on it. The video is on YouTube. Just on YouTube, just put ASML in, and you'll see a documentary. There's 2 documentaries there showing how it all works, and it's mind-blowing stuff. But the bottom line is, competitors can't copy it. Plus, they've got patents on all this technology anyway. And their supply chain is 7,000 companies, and a lot of them are on exclusive relationships. So they couldn't supply anybody else if they wanted to. So we don't believe it's possible to even remotely reverse engineer what they're doing. So what ASML has is a very, very strong tailwind, capitalizing on the AI trend, and they have a massive monopoly moat. which means that they have enormous pricing power. And you can see that in the price of what these machines cost. They've been 200,000 and growing. So the good news, the prices dropped recently. They had a quarter where revenue dropped off, earnings dropped off a bit, just purely on timing on deliveries and so on. We don't think it was a big deal. And it's delivered us an opportunity to buy ASML in the green. And in the green for us is the bottom quartile, bottom 25% of the range. And so let's have a look at the financials. So the first one is our research sheet, which is our summary of how we look at companies in Teaminvest. And on the left, you'll see Stret D, that's stock return with dividends reinvested. And we've got that at 31.5% per year for the next 5 years. So that's basically, if ASML just continues to keep performing at the current level it is, we should get a 31%. And if you break that down, we can look at the stability. The stability is 92%, so it's very, very stable. And return on equity, 57%, return on capital, 43%. These are all outstanding numbers. And their EPS growth rate is 26.6. So his earnings are growing at 26% a year, and the current PE is 35. Now, 35 puts smack in the green, which is the bottom quartile of our PE range. We like buying in the green because it means it's below its average PEs, which gives us more chance of doing increased, even better returns over the long term. So I'll just switch to the next chart, and the next chart is our calculate return one. And in there you see both the default and the margin of safety. So the default rate is at 31, margin of safety is 10.3 per year. We've found any companies that have above 10% margin of safety, we usually end up between that and the default. And the default is about 50% of the time above and 50% of the time below. So 10% on a margin of safety is actually very good. I'd be very surprised if ASML doesn't deliver 20% compound with the massive tailwinds they've got and their positioning in the market and the industry they're operating in. So it's an outstanding investment from my perspective. I'm a shareholder, so I'm definitely biased, and I am buying more, and it passes all the Teaminvest filters. So we class it as a wealth winner in Teaminvest. You need a US account if you don't have one, but if you don't have one, I suggest you get one because a lot of the best opportunities are in the US. So if you look at that, you'll see on there's 3 columns. The right one that says saved, this is just showing you what the breakdown of this return is. So we have a price that's currently $670 US a share. The earnings per share are $19. PE ratio, this is terminal PE ratio, we're giving it 40 in 5 years' time. It's currently 35, and that's in the bottom quartile. The middle 50% is 46%. 46 PE rather. So 40 PE is, I don't think, unreasonable. The growth rate is 26. That's the average EPS growth rate over the last 6 years, which we're predicting on our default setting. And on a margin of safety, that drops down to 14%. And I've got a required rate of return, which is my standard required rate of return on any growth company I invest in, is 20% a year compound. And 20% a year compound, if you achieve that, that gives you 6 times your capital every decade. So if you have $1 million, you have $6 million in 10 years. It's achievable, and it's what I require if I'm going to make an investment. And this meets that at 31. So there's quite a big margin of safety on that as well.
It has recently experienced a sell-off due to trade restrictions with China,
Yep.
Also lowered its guidance for 2025. What are those perceived risks as you see them?
Well, the risk is the political risk is they're restricted, or the Americans influence the Dutch to restrict the supply. So in other words, because the technology is so sensitive, the US doesn't want them selling their latest machines to China, so they're not. And what they've done is they've taken that out of the business. I think it was something like 16% of their business before. There's a DUV machine, which is an older technology. They're allowed to sell those to China, but they also have competitors with Samsung and I think Nokia as well. I think have some technology in that area. So the lower technologies they'll be able to sell, but the super high end is obviously become part of this trade war argument and so on. So I don't think that's a problem. It's very similar to NVIDIA. If you look at NVIDIA, they had the same problem. They were selling about 20% of their product was going to China, and all their top-end chips are now banned from China, but they're still selling the lower ones. And then they look at the rules and then try and work out, well, what can we design within the rules to make sure that we can sell some stuff to them. So they're doing that. I don't think it's a problem with ASML. And the reason is there's new fabs being built all over the world. There's several in the US. Europe's building them as well. Saudi Arabia is building them. Everyone's racing to get into the game. So everyone now sees it as a strategic imperative to be able to have a chip industry in your own country. Australia, not though. We don't think about things like that. And every one of these new fabs that are being built has to buy multiple machines. So ASML has got the next 5 years for sure, and probably 10 years of significant growth purely with the existing planned expansion and what's already in development already.